What's up, everybody? It's your boy Sat coming to you with today's stock pick, indicator help, and general investment tips. Remember, this channel is all about no face, just facts in 5. I do the research so you don't have to. Today we're talking about Sofi Technologies, ticker symbol SOFI. The stock is down more than 33% from its highs this year. Short sellers are circling, and investors are trying to figure out whether this is a falling knife or one of the best fintech opportunities on the market. So let's break down what's happening and whether SoFi deserves a closer look. First, let's address the obvious. The chart has been ugly. Shares have been stuck in a downtrend for months, consistently making lower highs and lower lows. Every rally attempt has been met with more selling pressure. That's never what investors want to see, but it does create an interesting setup because sentiment is negative. What's surprising is that the business itself doesn't appear to be falling apart. Management continues launching products and expanding the platform. One recent launch was SoFi Coach, an AI-powered financial assistant designed to help users make smarter financial decisions. Early testing showed strong engagement, suggesting customers are actually using the tool rather than ignoring it. The company also introduced SoFi USD, becoming the first national bank in the United States to issue its own stablecoin. Whether that becomes a game changer remains to be seen, but it shows management is still focused on innovation and staying ahead of trends. So if the company keeps innovating, why is the stock falling? The biggest concern is loan performance. Investors are worried that losses on recently originated loans could pressure earnings and profitability. In a higher rate environment, credit quality matters. If defaults rise, lenders feel the pain. Another issue is short interest. Current data shows roughly 170 million shares sold short, representing about 14% of the float. That's a meaningful bearish bet against the company and suggests many traders expect further downside. However, high short interest cuts both ways. If SoFi delivers better than expected earnings, improving loan performance, or stronger member growth, those short sellers could be forced to buy shares back. That's how short squeezes begin. The bull case for SoFi remains compelling. This is no longer just a lending company. SoFi has built a broad ecosystem that includes banking, investing, personal loans, credit products, financial planning tools, and digital asset initiatives. Few fintech companies offer that level of diversification. One advantage many investors overlook is the banking charter. Unlike some competitors, SoFi can gather deposits directly and fund loans through its own banking operation. That gives the company more control over funding costs and potentially stronger long-term economics. The company has also continued growing its member base. Every new customer creates opportunities to cross-sell additional products. That's important because the more products a customer uses, the more valuable that relationship becomes. But there are real risks. If loan losses continue increasing, profitability could remain under pressure. If the economy slows, borrowing demand could weaken. And if management's investments in AI and new products fail to generate meaningful revenue, investors may continue losing patience. Looking at the chart, the trend remains bearish until proven otherwise. The first thing I want to see is the stock stop making lower lows. The second thing I want to see is a higher low form on the chart. And third, I want to see stronger buying volume on green days. Those would be early signs that momentum is shifting back toward the bulls. Investors should also remember that SoFi has a beta above 2. That means the stock tends to move more than twice as aggressively as the overall market. When sentiment improves, the upside can be explosive. When sentiment turns negative, the downside can be painful. Here's my takeaway. The stock is under pressure, but the business isn't broken. The market is focused on loan performance while management continues building products, expanding services, and investing in future growth. Eventually, one side is going to win that argument. Personally, I'm not rushing to buy today, but I'm absolutely watching. If SoFi can improve loan metrics, stabilize the chart, and regain momentum, this could become one of the more interesting fintech recovery stories over the next year. So what do you think? Is SoFi a falling knife investors should avoid, or is Wall Street giving patient investors a chance to buy a future fintech leader at a discount? Drop your thoughts in the comments below. Let me know if you're buying, holding, or avoiding SoFi right now. And tell me what stock you'd like me to cover next. Remember, I'm not a financial advisor, and this is not financial advice. Do your own research, manage your own risk, and never invest what you can't lose. Don't forget to smash that like button, subscribe, and drop a comment with a stock or indicator you'd like me to cover next. This is Sat, and I'll catch y'all in the next one. Peace.